Good evening, everyone. This is Dottie coming from the new and improved Compass Consulting and Financial. How are you guys all doing this evening? Just want to give you an update. The name change did become effective on July 1st. I know most of you received a letter from us, and it had what was supposed to be sparklers in the letter, but it's under our understanding that the local post office ran those through the metering machine, and they were not supposed to be run through the metering machine. And so most of your sparkler dust was just that, dust in the envelope. So we do apologize for the mess. It was a great idea, just unfortunately not executed well by the local post office. We did want to celebrate with all of you with the name change. Some of you know that there are two Full Circle Financials in the Tampa Bay area. One is a debt collection and one is the financial planning firm. We have fought with this probably the last 25 years, and over the last 5 years, we decided that the fight was not worth fighting anymore. And so that is the reason that we did go ahead and switch back to Compass Consulting, as a lot of you know, is the name of the practice that I owned up in Indiana before I moved down to Florida. And if some of you remember, you guys received a letter back in 2020 during COVID where we had merged Compass Consulting with Full Circle Financial, which is when we rolled out the new website and the new logo. So all we did was just take the Full Circle Financial name away, add back in the Compass Consulting. So you guys will see on your statements that the logo is the new logo, but once again, everything stays exactly the same. We just decided to change the name to maintain the great legacy and reputation that we've had here in Florida as a firm, and wanted to continue that for you guys. So that was the reason for the name change. And once again, we apologize for the mess of the sparklers. But all of you, those of you that actually did go purchase additional sparklers and send us pictures, thank you so much. We will start rolling some of those pictures out on social media, and you might be surprised to find your picture in next year's calendar. So that was the reason we had sent the sparklers out, as we just wanted an opportunity for all of you guys to celebrate with us the new name change. So if you still want to submit pictures of you holding a sparkler and celebrating with your family, don't hesitate to send those in to us. All right, so we are doing the market update this quarter a little bit differently. That is due to some scheduling conflicts that we had. So in order for more of our clients to participate in the market update, we decided to go ahead and do a recording this quarter and send it out to you so that you can watch it at your leisure. So I hope you made your bucket of popcorn, and we'll go ahead and move forward. So the U.S. economy is still growing, but there's definitely evidence building that the pace of that growth is slowing. The labor market remains resilient, but it is starting to show some cracks, especially in the service and manufacturing sectors. Inflation finally slipped below 3% last month, but remember, this could potentially be revised, but this is what the Fed was looking for. Their goal is still for inflation to remain at 2.5% or lower. That means prices are going up by 2.5% or less. So that is what they're looking for. But basically, the Fed really does need to lower interest rates. The situation that we're in now is when and how many times this year. The consensus had gone from anywhere from 10 times this year to 6 times this year to now 2.5 times. Not sure how you can lower rates 2.5 times, but the consensus is kind of all over the place in the market, and the market has tried to price that in. But in all honesty, I don't think the market has priced in that first Fed cut, because the concern is how large will the cut be, and then how frequent will they cut after that fact. So that's the reason we're still taking a conservative approach to the markets. I am looking forward to be able to take advantage of some of the volatility that will come from that. But in all honesty, it's kind of like you don't know the pain until the pain happens. So until the Fed does that first cut, I don't think we really know how to move forward and how to prepare for that. However, the great thing is, as long long as the Fed is not cutting rates, we are still enjoying those great money market rates of over 4.5% or higher. A lot of you that have the money markets on the Dunham platform with me, you're still sitting at 5.15 on your money market rate. So at the end of the day, we're getting paid 5% to wait to see what the Fed is or is not going to do. But we will take advantage of the volatility that we expect to come into the markets because there's a lot going on over these last few months of the years, and we're going to talk about that. Okay, so the extreme outperformance of the anointed technology stocks mask a slowdown in parts of the U.S. economy. So like I said, even though the S&P 500 is up just over 18%, 60% of that is attributed to 5 companies. And I know a lot of you are looking at your statements and going, hey, the S&P is up 18%, but we're only up 4.5%, 5%, 6%. Well, that's because you're not invested in those 5 companies. You have a more diversified portfolio. And so keep that in mind. Remember that when we're looking at the S&P 500, that there are 500 stocks in there, and unfortunately, only 5 of them are representing 60% of the performance. And that's not a great portfolio. And that's the reason your guys' portfolios do look a little bit different. And, you know, we do want to be careful about how we're allocating across different sectors, especially when all 5 of those stocks are, you know, not necessarily diversified across all sectors. We have a couple of them in the same sector. So we have to be careful of that. Now, of that 60% section of the S&P 500 performance band from 5 stocks, NVIDIA has driven a third of the S&P 500 returns. So you got to remember, if 60% of it is attributed to 5 stocks and a third of it is attributed to just 1 stock, what does that really say about the viability and the sustainability and the safety of, you know, saying, well, let's just invest in the S&P 500 and take advantage of that. So like it, because its share price is up 162% year to date. That's as of June 13th when we ran the numbers. So, you know, this year presents a very unique phenomenon as most investors realize that there will be a day of reckoning for these lofty AI stock valuations. Because we're starting to look at numbers that mirror what happened at the end of 1999 before we went into the tech bubble. So that's the reason we are taking a step back, trying to keep our emotions out of the market when we're putting our portfolios together, because we do want a diversified portfolio. We do want to take advantage of what, you know, any growth that we can get out of the markets. But I do have to do it according to your risk tolerances and, you know, looking at each of your individual financial plans and what our goals for you are. So we do look at each of your portfolios individually, and we do match those up to your financial plans that you have. And so if your risk tolerance is not going to allow you to be 100% S&P 500, you're not going to be 100% S&P 500. And that is the benefit of having a diversified portfolio, so that we can take advantage of moves in the market, but also protect you from those moves in the market. And like I said, this year does present a unique phenomenon. As most of you know, there is going to be a day of reckoning for these AI stock valuations. And for investors like us, the ride has been rewarding, but there has to be a key to dismount. So, you know, yeah, we're not riding on an 18% year-to-date return right now, but I'm okay with that because at the end of the day, you know, when the market corrects, if the market corrects, you're going to be better positioned to be protected than if we were to just, you know, hop on the S&P 500, because as most of you know, the S&P 500 can move 5, 6, 10% a day. And then we need to be able to get in and out of that in a viable format. And so that's kind of the reason we've taken the approach that we've taken. In other words, when should gains be realized and portfolios shifted from the AI tech to other securities? Well, there's actually other niche areas to watch that could be such powerful forces that they're not as affected by the economic slowdown. And what do I mean by that? Well, just for example, the AI-fueled future that everyone is talking about is going to require massive amounts of power. And we hate to break the news that sun and wind will not be the sole source of this power. So we can look at select commodities like natural gas and uranium as potential sources, but we also want to look to the technologies that help make use of resources more efficient. So AI seems to be the trend that is pushing the markets, but what is actually going to push the trend of AI? We got to be able to power this, and then we also have to have the technology to implement this. And those are areas of the market that we would rather focus on for those long-term sustainable gains versus short-term market burst. All right, so I'm going to give you guys a little bit of history and perspective. I started back in finance in 1994. I cannot believe 30 years. Now, in 1994, long-term market outlook was an average annual return after inflation was 6.7%. Do you know what the long-term market outlook after inflation is today? 6.7%. So think about everything that's happened in 30 years: the tech bubble, the financial crisis, the pandemic, wars, all these other things. And the return on stocks has remained remarkably stable and steady. And that's with an approach of an efficient portfolio that is well diversified to produce income when we need it, produce growth when we can get it, but to produce capital preservation when we can protect it. However, to understand this and to embrace it, you do have to have a long-term outlook on your portfolio. And in 20 years, 30 years of me doing this, no one has had a long-term outlook, which is why we do have a more conservative approach, and then maybe take a more aggressive approach and then go back to the conservative approach. And that's because most investors cannot take the short run volatility. So, I mean, if I was able to tell you in the summer of 2008, say, hey, if you just hang in there, the average market return is 6.7%. Most of you would have been like, no, this is not what we want to do. And after the market gave up 40%, most of you would be like, what are you thinking? Why am I still in this portfolio when it's down 40%? The thing is, though, had we stayed in those portfolios, we would have recovered an average 6.7%. But you would have had to understand that you got to take that 40% pullback and then watch it continue to grow after the fact in order to be able to realize that 6.7% average annual return after inflation. Like I said, 30 years of doing this, not a single investor has ever been willing to just ride out the ride. So keep in mind that every portfolio is different. Every client is different. Your neighbor is different. So if your neighbor is telling you that, hey, I'm getting 12, 13%, good for them. Congratulate them. But then look at your financial plan and ask yourself, do I need to take the risk to get a 12, 13% return when my portfolio is designed to get me closer to that 6.7% average annual return with considerably less risk? There's a lot going on in the markets. I know that a couple of years ago we were talking about Bitcoin, and now hardly anybody talks about Bitcoin anymore. Now everybody's talking about AI. But in all honesty, if you really take the time to research AI, we're 20 years out from AI actually being a common day, everyday thing. A lot of the companies that we have seen have implemented AI and then have immediately removed it from their software or hardware systems, or in the process of removing it because it does bog the systems down. It's also not nearly as secure. And at the end of the day, I don't think you guys want me using AI to write my market research articles versus making sure that we are protecting your assets, protecting your information on a daily basis. And that's where I would rather focus, is how do I protect you and how do I help you reach your financial goals? All right. We're 4 months away from a presidential election. You guys know I hate talking politics, but everyone has the questions. So here we go. The election season promises to be unpredictable and could bring volatility back to the stock market. So as I said last quarter, buckle up and make sure you have some cash on hand for buying opportunities. By the way, almost all of you that have the active managed portfolios with me does have cash on the sideline to take advantage of the volatilities that we expect in the market. If you want any of further of my opinions or thoughts on the politics and the effect on the markets, I would prefer those to be one-off conversations because, like I said, as most of you know, I hate talking politics. I'd rather talk about your financial plan, talk about your goals, and see how we're going to get you there to reach them. I hope you guys have enjoyed the recording. I hope the popcorn was good. If you do have any further questions or concerns, please reach out to us. We'll be happy to get you on the calendar for an appointment. As always, thank you for your confidence and your trust in all of us here at Compass Consulting and Financial, and have a great evening.